Assalamu alaikum, everyone. We can start the Investor Masterclass right now. My name is Mohammad Ayub Khuhro. I'm the Chief Investment Officer for Alfalah Investments. This is a small session that we have created for anyone who wants to learn what mutual funds are, how they can go about investing their future. And when people do want to invest, you have to figure out what is the most efficient method, what is the most ideal method, depending on their risk profiles and how they want to uh, have their savings or what is the purpose of their savings. So let's start and with the agenda of the meeting today. So 7-point agenda. We're going to start about mutual fund basics. Then we'll go on to investing. And then why investing in Pakistan, right? So we look at the economic outlook for 2026 and especially the stock market outlook, I think, because that's a exciting space for everyone. That is, I think, a key area where one can generate absolute and real wealth. And how to do that tax efficiently, how to plan your goals, how to uh, fit mutual funds or any other vehicle that might suit those goals. So we'll go through that, and then finally we'll have a Q&A session in the end for any questions you might have. Okay, let's start. So what are mutual funds? I think you have heard this term a lot, especially in recent times when the market has started rallying. A lot of people are talking about mutual funds, invest in mutual funds. So essentially, simply, let's break it down. Mutual funds is just a pool of money of multiple investors that is professionally managed by a team of fund managers that is overseen by an investment committee of professionals again. And the fund managers and the investment committee decide what's the best avenue to invest that pool of money in. And what happens is that the investor gets a lot of efficiency, gets the best rates, and gets diversification across all asset classes depending on what type of fund they have invested in. So it's an easy vehicle for somebody who does not understand complicated products, who does not have the time for uh, have to look at the stock market daily or talk to your banker every day or what is the TDR rate, everything. So everything is it's like an autopilot for your investment and savings. So easiest way is simply diversification. So you have multiple options here from low risk to high risk. There's a professional fund management team that is overseen by investment committee. There is a risk, there is compliance, there is a research department that is looking at all kinds of avenues for the best areas where you can generate money, right? And the best part, you don't need to be a millionaire to start. You can start as low as 500 rupees, 1000 rupees. So it does not matter at what point of life you're in, at what kind of income levels you're in, you can start anytime. So it's a great vehicle to get started. And the last point, I think daily pricing and transparency is very important. There are a lot of schemes out there that people pitch and or we'll double your returns, we'll quadruple your returns. But this is the most transparent tool available. There is a trustee involved, there's a regulator, SECP, overseeing all of these mutual funds. So there's a lot of transparency, there's a lot of trust that can add value to where your money goes. I think it's a very important and very understated point that people should give money to institutions that are professionally managed and there are there. So this is very important when you do your savings. So type of mutual funds, you have your high risk equity funds, which offer high growth, but they offer high volatility also. Again, because they're going into equity markets not always have been very stable, especially in a country like Pakistan. You have ups and downs during the economic cycle. So you have to time those cycles. And that's where we come in as fund managers to figure out when is a good time to invest in equity markets. Then you have income and money market funds, which offer stability, kind of like a bank account, right? So it's kind of like a saving account. You're getting the rate, whatever the discount rate, you're getting that rate. Where it's very safe, very simple, just plug and play. And then you have a mix. So you have those balanced and asset allocation funds, which offer an equity allocation as well as a money or income allocation. You can have capital protected structures as well if you want to have exposure towards equity, but you want that capital protection feature. So you can have that as well. And then Islamic funds. So all of these funds, we all have Islamic variants, the Sharia compliant variants of all three major asset classes. So depending on whether you want to go Sharia, you want to go conventional, all options available. And then finally, this is a new space for mutual funds, which is the REIT space and private equity. Again, these are for sophisticated investors who understand the risks associated with going into slightly more riskier avenues. But as interest rates keep on coming off, and we are at 11% already, let's say they go down to single digits, then you want to look for assets, or you want to look for funds that can deliver still double-digit returns. And so you might have to diversify your investment base from just mutual funds to REITs and private equity. So that's the next leg of our journey. But right now, we'll stick to mutual funds today. And simply just giving you a profile based on risk. You have your fixed return funds, which act like a TDR, which is your safest avenues right now in mutual funds. Then you have the money market fund, which is um, still green, but again, it's as safe as they can be. And then you have the income funds and the sovereign fund, which I would say have a slightly longer duration towards your portfolios, but they can offer superior returns. In a falling interest rate environment, for example, we believe that the income and sovereign funds offered a slightly more return than a money market or a fixed return fund. Similarly, if interest rates start to rise, probably the money market fund would be slightly a better vehicle than a sovereign fund. So depending on where we are on the interest rate cycle, depending on what kind of investment avenues are available, you can ask your fund managers, you can ask your investment RMs how to guide you towards which is the best fixed income fund. On the equity side, then you have asset allocation, you have equity. These are pure equity plays into the stock market. And again, I would highly encourage you to talk to your investment advisors, your RMs, or any fund managers that can guide you towards equity. So equity is I think one of the best asset classes we have in Pakistan for the last 3 years. So we're going to talk about a bit about more about equity going forward and give you an idea whether do you want to take that kind of risk, or you have to understand what kind of risk you are taking, why you're investing in equity, why you're investing in Pakistan. So let's go into our next phase. So if you don't invest, inflation basically is very high in Pakistan, and that reduces your overall wealth, reduces your savings. So you need to be invested in a fund or an asset class that can beat inflation, so you can generate some real wealth. Bank deposits are linked to discount rates, which is linked to inflation. So all three move in tandem. So you're not really beating inflation by a lot by just putting your money in a bank deposit. Investments, actual investments, especially stock market, especially REITs, especially private equity funds, they create long-term wealth. And that's a space what we try to encourage our investors, that you want to create long-term wealth. And you start early. The earlier you start, the better wealth you have developed over a period of time. So the time value of money really matters. So we encourage people to start early. The opportunity in Pakistan is simple. Everybody knows if we have a very young population and we need to start our savings culture early. Pakistan is unfortunately does not have a very high savings culture in the past, but we need to change that culture. And young people usually means that the economy has a potential to grow because you have a lot of working labor coming into the market soon. We have a growing digital financial ecosystem. There's a lot more inclusion in the banking space, in digital financial space in the last 5 years than the last 20 years, what the banking channel has brought in through their brick mortar system. So a lot of people are getting access to financial apps. A lot of people are getting access to banking apps. Uh, so you need to figure out how you have the access, but then you need to diversify, invest, use those apps, these digital apps to find the best avenues to make money or make wealth or make even savings, simple savings. Capital markets is the other avenue. In the last 3, 4 years, we have seen a lot of accounts getting opened in the stock market. I mean, it is literally exponential how many accounts are getting opened every day in the stock market compared to like 5 years ago or 10 years ago. So a lot of people are already moving towards independence, financial independence. People are learning how to open stock market accounts, how to invest through mutual funds. So it's important that everyone also should know. And if you don't, then you can contact us or reach out to any of our RMs who can further guide you towards the space. Coming to Pakistan, why we want to invest going forward, I think key themes. Pakistan has been going through a very stabilizing last 3 years through the IMF program. Inflation has finally stabilized. It's in single digits. We foresee that inflation going forward to remain in the State Bank approved band of 5 to 7%. So that's pretty much inflation is pretty much controlled, I would say. There are a few variables that do affect inflation, like food prices, oil prices. Uh, Nothing seems to be indicating that there will be any significant deviation on that front. Foreign reserves is another factor that has played a big theme in the at least last year's stock market rally. Following the IMF program, we have built serious reserves. We have seen, and actually what has happened, the quality of those reserves is very important. A lot of people say it's borrowed money. I would say that the quality of those reserves is much better than what we had 10 years ago. Policy rates have declined after a stabilization period of 2 to 3 years. Since last year, we have started reducing policy rate, came down from a high of 22% to 11% already. We might see a further reduction in 2026. So these themes all add to the economic recovery story of Pakistan. Corporate profitability, again, high interest rates made companies, uh, run left, right, center to save costs, to save from their financial cost. Business was not doing well. But in the last 1 year, we've seen the policy rates come down, inflation stabilize, and these corporates have again found ways to increase their margins, increase their profitability, and eventually all of this boils down to the performance of their own stocks, and essentially how that's how the stock market performs. So we've seen IT, banking, energy, even construction rebound from the last 2, 3 years of economic consolidation. So what this means for investors is that the more the stable in the environment, the more growth options available for investors, we see better long-term investment opportunities, especially in the stock market. And I think, again, the last 2 years, you've seen a massive bull run in the equity markets. We feel that will continue to do so going forward as well. So let's dig deeper into the stock market outlook. I think a lot of people will be interested to know what we foresee going forward in the stock market. So just a quick recap. The market is still trading at deep discounted valuations. The monetary cycle easing that started in June, policy rate declined from 22 to 11%. The PE of the index on a forward basis has come up to 7.9. When we started this rally about 2 years ago, the PE had come down as low as 3 times. So you've doubled on the price earnings multiple, but it's still well below the 10x average during 2012 to 2017. So, so a lot of people say that Pakistan's last 10-year average of PE has been 8 times, and we are already there. But you need to consider that the bull cycles, when the Pakistani economy is doing really well, and there are periods of economic sentiment is positive, the P actually goes above 8 times. It goes to 10. It even has touched a high of 12 to 13 times. So there is ample opportunity available in the stock market even today. Corporate earnings cycles have turned positive. Pakistan's current market cap is about $67 billion. In 2017, it was $99 billion. So there's a long way to go for corporate earnings, corporate profitability to bring those valuations back up. So what it boils down to is that we see the benchmark index crossing or surpassing 200,000 points in 2026. So this should give you some comfort of how we are seeing the market. We are seeing there's some developments on circular debt, which will help energy stocks. We see the next IMF tranche coming in December, which will help our foreign reserves. We see strengthening liquidity coming into the banking system, into the financial inclusion, which will eventually find its way into asset classes such as equity. We see interest rates having already halved from 22 to 11, further reduction, which will add further valuation upside to the stock market, right? So all factors contribute towards sentiment where we see the equity market to perform. The the third major point about equity markets, about how we see equity markets is always there's a political element to it. In Pakistan, where we have very high politics, which eventually trumps economic policy, we see that for the last few years, we've seen a little bit of stability on the political front. And going forward, you can imagine that this year we get the KSE 100 gave a return of 45%. This year we had trade tensions, we had geopolitical conflicts, regional conflicts, we had a devastating flood this year. Despite all of these challenges, uh, the stock market gave a return of 45, 46% during the calendar year. And if we see there is further reduction in all of these geopolitical events going forward, so we can expect the market to perform even better next year. So giving you an historical perspective for the last 20 years, so KC 100 on if you see the graph, has its cycles. It goes up, goes down, depending on the economic cycle, depending on the political environment of that time. But since the last 2 years, you see this is a massive uptick. And today we are trading at, we even crossed, with charts showing 161, we have already crossed 161. We're already at 165, 166,000 points already. So we foresee next year to cross 200,000 points. So to give you an idea of what I was talking about price to earnings ratio previously. So this is what is often mostly quoted by everyone. The 10-year average of PE is 7.98, 8x is what people quote. And the last 5 years average was 5x. So we have already come to 7.9 times. But if you see historically in November 15, July 2016, March 2017, you see that P ratio going up, even as high as 14 times on this graph. But I would say in times of economic recovery, in times of economic bull cycles, which you're expecting that Pakistan after 2 years of consolidation wants to put down the accelerator on growth right now. So you see that price earnings multiple go up. And with falling inflation, with more economic confidence, more consumer confidence, more liquidity coming into the equity market from fixed income funds, from other asset classes, we see this multiple to go at 10 times, 11 times. And that's where the real wealth making opportunity is right now. If you look at economic multiples across the region on price to earnings, Pakistan still is one of the cheapest in the region. Similarly, on return on equity, what if you invest 100 rupees, what is the expected return on equity for an average investor? You would see still is one of the highest in the region. Price to book is just another indicator right in the middle of the pack, but still cheap to other relevant valuations. Dividend yield, I think this is a key question a lot of our investors ask, and because dividend yield is a very safe avenue that even if there's volatility in the market, dividend yield is something that you're assured that you'll get a certain dividend yield to run your household, to manage your kitchen expenses. So Pakistan still has one of the highest dividend yields in the region. So that should give a lot of comfort to a lot of investors that despite volatility, you are still getting good dividend portfolio yields on for your expenses, for your expenditures. So all four variables that we see all point towards a very, very decent recovery, very decent outlook for 2026. And one should take that opportunity to take advantage of. Coming further, breaking it down, just from looking, we looked at the overall stock market, but looking further down, what sectors, where we think performance is. So we'll go in a bit. I'll just show you a few graphs actually. There's just a small presentation on how we view sectors, how we view economic recovery, and just to give you an idea, uh, because these are graphs that we discuss about in our investment committees with our fund managers, and this is the real crux on how you should view the market also and what sectors to view based on some of the ideas that we generate from these graphs. So I'll give you an example. We'll start with oil marketing companies. So very simple. This is the last 10 years demand for MS and HSD, which is petrol and diesel in Pakistan. As you can see, the black and red lines is our growth rates. 2016 to 2020, we had very high demand, and post 2019, 2020, FY20, though HSD sales fell. A lot of reasons behind that. Recovered somewhat in 2021, but again, FY22 we had our peak HSD and we had our peak m- petrol sales. But post 2022, we went through an economic consolidation phase. FY23 was a very low sales numbers for diesel and petrol. FY24, we again consolidated. But FY25, now you see the red line and the black line, you see the growth rate in our consumption for petrol and diesel. It is coming back up. That means that there are more trucks, there are more cars, there are more motorcycles on the road today, and this is a much more faster way to gauge growth in the economy. And this is instead of waiting for GDP growth numbers every year, so this is a key number that we look at. Diesel sales goes up, that means there's a lot more transportation happening of your trucks going from Karachi to Lahore and back and forth. So business is actually starting to perform. This is the real underlying economic indicator that we use. Similarly, the other one, crude oil. Pakistan, a lot of investors say is very susceptible to international oil prices. And yes, oil prices, oil imports, our petrol imports, our diesel imports, our crude oil imports are the highest component of our import bill. So we should be worried about oil prices when they go up. And that's when our economic recovery, takes a little bit of a hammering. So in the last 5 years, oil prices made a high of $127 in somewhere in 2022. And since then, oil has been on a secular downtrend. Prices have been year on year just coming off. And right now, it's at a 5-year low. And from all the economic big research houses that we talk to, whose reports that we look at, everyone is forecasting that oil prices will continue to be bearish going forward. We looked at international big houses, research houses who give forecasts on oil prices. All have a very similar trend that it's bearish going forward. So we're looking at maybe $50 to $55 outlook for Brent oil going forward, which all again bodes well for Pakistan because this is our biggest variable of our import bill. So any price that falls going forward, that'll save us on our current account, that'll save us on trade deficit. All of these things are very important. So the other sector, I think the flashy sector that everyone talks about because suddenly, there are all new cars on the road and there are more and more cars coming, more and more models of new, especially Chinese cars coming. So I think this is a number that one needs to keep track of. So this is simply a graph of auto financing. Auto financing is, again, how much money people take from the banks to buy cars on hire purchase or lease or loans. So you see, since June of 2012 and 2013, there's been a steady rise in auto loans. And similarly, there was a big sale boom for cars also. But last 3 years, again, we saw that dip from 367 billion worth of loans. Suddenly, the market went all the way down to 227 billion. So almost 140 billion worth of loans were paid off, and there was no new cars bought or no new financing taken. But since February 2024, you see this rebound in auto financing. And this shows that are actually people going out and buying more and more and more in cars. So there is this consumer demand. This consumer demand is coming from higher incomes, from higher savings. So that's how we keep track on the very fast, high frequency indicators. The same graph in a very short term, if you see, the growth rate in auto financing is going at almost 33% year on year. That's a very high, fast uptick in the loan book, and that translates into car sales. But what particularly we are more important about is what kind of car sales that we want to look at. So this is an overall sales of cars in FY22 when the loan book was at high, you saw 226,000 cars getting sold. Similarly, then it fell to less than 100,000, fell to 879,000 in FY24. Now we have seen a rebound. There's a rebound in car sales. It's only at 111. So you can imagine, despite all the flashy headlines you get about new car models coming, about new sales, about new Chinese cars, we are still at halfway point of our FY22 numbers. So there's a long way to go. And that shows how much potential there is potentially in further economic activity. The truck sales, I think this is auto sales we left off. So again, so I would like to say that, truck sales, because more important than car sales is really important, because majority of Pakistan's economic activity from factories, from your ports to warehouses to end consumers to end shops is all based on trucks. It's all based on transportation. Truck sales is the real heart of our gauging the economy, and truck sales is that barometer how we can gauge. So you see, again, FY22 was a great year, but post FY22 we had the almost default of the Pakistan economy. We had the IMF coming in to save us. We had a big PKR depreciation. So last 2 years, again, I would say consolidation years. FY25, we've seen an uptake in truck sales. And in terms of Y and Y growth numbers, massive, massive growth. And we expect FY26 to even see a bigger growth in truck sales as the economy rebounds. So this was the key theme, that going forward, that truck sales goes up, diesel sales goes up, and that's how we track the growing economy. Cement is another big, 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 big construction. It's a proxy to the construction sector. You see, FY21, we had massive sales, almost 58 million tons of sales through local and exports. FY22, it dropped a little bit as interest rate starts rising. Construction demand came to a halt. People were very wary of taking house loans, construction loans. It became just very difficult to even build a house, build a building, because all economies, all uh, businesses were slowing down their purchasing, slowing down their profits because of high interest rates. So last 2 years again consolidation, and now finally after 5 years of Y and Y negative growth in cement sales, this is the first year we have seen actual growth in cement Y and Y. It's at about 6 to 7%, but hopefully we can see maybe a double-digit growth next year, and that is showing you again a rebound in the construction sector. That I take this as a proxy to the construction sector. So that was on the economy. This is what we discuss when you're looking at sectors. This is what we discuss when you're sitting in an investment committee on how to gauge the economy. We can't wait for the GDP growth number. We can't wait for these other economic data that comes out very late. We need economic data that comes out monthly so we can track, we can quickly assess, quickly figure out what sectors to buy, which stocks to buy, even if to figure out if the outlook is positive or not. So all of this helps us. And now, once we figure out if we want to invest, if the economy is recovering, the corporate earnings growth are recovering, what sectors are looking great, how to invest, how to plan efficiently, how to especially plan tax efficiently. Pakistan has a very personal high tax rate. Everybody, whoever gets a salary, whoever gets a bonus, whoever gets business and profits from any of the businesses, you have to pay a very high amount of tax. So you have to plan efficiently. So one way is mutual funds, and that's how we have been promoting mutual funds as a tax efficient way, a smart way of saving money. So the crux of how mutual funds work is the income from mutual funds, primary income that we all uh, generate in a year. We want to take that out as final tax by taking capital gains at 15%, which is considered full and final. There's no more taxes on this. Versus if you put your money in a bank account, or you put your money in a T-bill or a TDR or any other investment avenue, the income or the profit that comes from those avenues is taxed at the normal tax rate, which is your own tax rate. So as your incomes keep going up, and when your incomes are really, 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 really high, the tax rate commensurately goes up, as high as uh, for an AOP as high as 49%, for a salaried class as high as 35 plus 3, 38%. So now looking at 15% full and final versus a very high income earner earning like 38% on their bank profits. There's a big difference. So that's the real charm of mutual funds. So that's just tax. You don't even have to worry about your TDR rollovers or T-bill rollovers. Here it's plug and play. You invest and then you forget. Just keep monitoring them every once in a while. So there's a very big potential of how you save money. The second avenue of mutual funds is VPS, which can't be understated. You have to start saving in VPS schemes. They offer tax credits anytime you invest based on your salary, based on your income levels, there's a certain tax credit given to you. The mutual funds had a similar tax credit, but that was taken away about 2 years back. So that tax credit is still there in VPS. And you can say a lot of taxes, you can say a lot of, and the way it works is that you get this cash upfront. So the time value of money of this cash year or every year that you get, you can make a lot more a compounded wealth effect from these savings in VPS schemes. And you can control the VPS schemes also between money market, income, and equity funds. So we have that flexibility. All mutual funds offer that flexibility for VPS schemes as well. It's flexible contributions is ideal for retirement planning. So VPS is a very, very good tool for future planning. You have to start early. More emphasis has to be laid on starting early. I think that is the key. Plus, insurance. So at Alfalah, we also offer insurance, free insurance with your investments. So you have to ask your investment advisor how you can get that. There's a certain amount of benefits that you get by investing in funds. So you always need to take advantage of what kind of further value-added services you can get from mutual funds, other than just the economic return of the money market or the stock market. So all of these are always available. And based on what your goal is, based on what your risk ability is, that's how we talk to investors. So if you have a long-term growth plan, you don't have an immediate need of money right now. So ideally, like if you have a 2 to 5 year horizon, maybe 10 years, then equity is a very good way to grow your wealth. If you just want a steady stream of income on a monthly basis to run your kitchen expenses or any other short-term goals, your money market income category offers you that flexibility. But let's say you are risk averse, but you still want the exposure to the equity markets. So the asset allocation and the balance strategies and the capital protective strategies come in play, where we try to protect your principal and give you that exposure to the equity market. So you get the flavor of both markets and in a much more safer, much more controlled environment, otherwise through a direct equity exposure. And finally, retirement savings. We spoke about VPS. VPS start early. That's only one thing I can say about that. The final avenue that we're looking at is systematic investment plans, SIPs. SIPs work wonders worldwide. In Pakistan, we don't have a savings culture, but what essentially it means that every month you need to take out a certain percentage of your salary, certain percentage of your profits from your businesses, from your incomes into a savings pool, be it mutual funds, be it anything else. So you have to be very consistent with it. But over time, this pool grows and it can be as low as 100 rupees a month, literally. So it just depends how consistent you are with your planning, and this really uh, grows over time, and there's a very big compound effect about SIPs. Um, so investing is easier than before, like we talked about. Financial apps, digital apps, financial inclusion. Even Alfla has digital apps right now. It can be as easy as WhatsApp, as easy as just an app. You can download and go quickly, very quickly through mutual funds. You can talk to our RMs, you can talk to our investment advisors, and you can get all the materials you have online or anywhere else, as easy as that. All right, so that was the end of the presentation, and now we will take some questions from the audience, and that's the next step. So let me just open it up, and then we can take questions. Okay, one basic question we see in VPS mechanism, how it works. So VPS is very simple. You open a VPS account, you invest based on your salary. If you invest 20% of your taxable income in a single year, you get maximum tax credits against it. So let's say your tax rate is 30% and your annual income is 10 million. So 20% of what you earn, you invest, which is 2 million rupees. 2 million multiplied by your tax rate, which is 30%, you get a tax credit of that amount. Very simple. There are tax calculators available on most mutual funds websites, and as easy as that. So next question is on the asset composition of VPS. So again, every mutual fund, not just Alfalah, be it any other asset management company, publishes what we call a monthly fund managers report. That fund managers report contains everything about that fund, from asset composition to top 10 investments to sector allocations to what T-bill they're holding, what Sukuk they're holding, everything. So again, in the case of VPS, the asset composition is again depending on what VPS you selected. So there is money market, there's income, there's equity. So all the allocations of all three you can look, and you can decide which one you want more, which one you want less. So everything is there. Minimum tenor for investing in equity funds. So I would say, see, problem is that over the long term, in the last 20 years, the equity market has given a return of 20% or more on average basis. But that does not mean it gives 20% every year. It gives 60, 70% one year, and then sometimes there's a negative return. So I would say that if you're investing for 1 to 1.5 years, you just have to be a little careful on you just have to be aware. You have to keep a little track of your investments and keep engaging with your RMs or your fund managers and asking them for advice if if the market is turning, if there's some political volatility, if there's oil prices are going up, if let's say cement sales suddenly drop. So these are indicators, these are things that you can keep track of on how you want to gauge the equity market performance, and based on that you can reallocate your exposures or take out from equity, go into fixed income. Um, the next question that we have is again on similarly on equity. Is balanced funds are considered medium or high risk? So balanced funds by definition are balanced, that they're investing some portion in the money market or income and some portion in equity. So they are slightly lower risk than equity funds, but they still have risk. So balanced and asset allocation funds, capital protected funds, those are funds for people who do not want to have an open risk to equity. They want the fund managers to have some control over the allocations of the fund so that they can give a slightly more risk adjusted return instead of a pure equity risk. So it's worth considering. It is absolutely for investors who don't want to take a risk on the capital. Other one, again, equity related, is sector specific. Yes. So a lot of AMCs have come up with sector specific funds. At Alfla, we're doing the same. We already have a financial sector fund. We're looking at other avenues also. We're looking at dividend funds also. We also have an ETF that tracks consumer stocks. So again, it's a you have to choose what sector you think is performing, and based on that performance, you can go into sector specific funds, or you can stay in a regular stock fund which tracks the KC 100 or the KMI 30 in the Islamic case. So the second question on again on equity is dividend. So we have 100 rupees. I've invested in a lot of companies. Each company gives me a dividend. Some give me quarterly, some give me annually, some give me semi-annually. The dividend is part of your return. It is compounded in the fund itself. But when you want your own profits, I would suggest you take your profit out as and when you are required. So mutual funds annually give a dividend in sometime in June, and this is the amount of profit that we made during the year. We give that out as dividends. So it really depends on the investor. If he's a long-term investor, he'll get a dividend on an annual basis. But if you want something specific, something earlier, you can take some part of your profit out as per your own request or timings, right? It's not that difficult right now. So next question is again about outlook of some stocks. I don't think I can comment on stocks. So you have to invest in the fund. Sorry, can't do that. So interesting question on CGT. Yes, there was a time when about 2 years back, if you held it for 6 years, you would have gotten zero CGT. But since the last 2 years, that rule has changed on how CGT works. Now there's no concept of holding period. So anything that you've purchased this year or last year, you have to pay CGT at 15% on equity funds as soon as you take your money out. Again, if you take a dividend from an equity mutual fund, that's also 15%. So it works both ways, 15% on dividends, 15% on CGT. For income and money market funds, it's slightly different. Uh, there you have a slightly higher tax rate on dividend income and a lower rate on capital gains tax. So I would suggest on a fixed income or money market fund, again, take CGT because that's a slightly lower tax rate at 15%. So uh, again, not going to talk about specific stocks. People want to ask about specific stocks, so can't do that. Sorry. So fee structure of funds, I think very important. Everything is contained in the fund manager's report, and fee structure is very, I would say it's very uniform across all mutual funds. So your money market funds would probably charge the lowest fee, your income funds would charge a slightly higher fee, and equity funds would charge the highest fee within our mutual fund space. But the whole idea of our target returns is to beat the benchmark. So if the fund manager is able to beat the KC 100 or KMI 30, I think that's our target. And the fees or the management fees and the expense ratios that we charge is all inclusive of the net return that we give to clients. Anything that we post in our fund managers report, that's the net return after taking out of all expenses and costs that we incur while doing the purchasing or selling or taking off buying shares. So it's the net return that you should be looking at. Quick question on, again, back to VPS. I think there's a question on if you withdraw early. Yes, there is a tax if you withdraw early before retirement. You get taxed at your last 3 years average tax rate. So if your tax rate is, let's say, for the last 3 years, 20, 22, and 24, so your 3-year average tax rate is 22%. So whatever money you have invested in the VPS, you want to take it out, let's say in year number 4. So the principal and the profit both will be taxed at 22% average. So it's not, the VPS scheme is not ideal for people who have very short duration investment goals. The VPS is meant for long-term savings. It's meant for you to take out when you retire or you have gone through an investment cycle of 25 years. So that's why I keep saying start early, because then your 25-year holding period starts early as well. And I would suggest that if you want to invest in VPS, only invest that amount in VPS that you can put away for 25 years or till your retirement comes. So while you invest the rest of that money in a mutual fund, which is much more liquid, much more redeemable, much taxed much less than your average tax rate of 3 years. So there's a young viewer we have who's asking us if he wants to be specific about his investment goals and invest for a long period of time. I would say if you're a young student, if you're a young professional coming into the job market, you should start early, number one, and you should not be looking at stable income. You should be looking at capital appreciation, wealth growth, because you have age on your side. So you want appreciation of your wealth, and that's the way to go. Okay, so we're gonna just take two more questions and then we are done. So, so the last question, the second last question is, can people invest under 18? Yes, they can. Of course, they can. If you have a bank account, you can open a bank account before you're 18 also. So you can invest in mutual funds. Again, you have to talk to the RMs. How can they best facilitate you in opening a account? You can even open a minor account for your kids. So it's very easy. And you can start your home. Everything is digital now. So you don't even need to come. Another quick question that we have is, I'll take one more question after this, is can AMCs, can RDA investors, overseas Pakistanis invest in mutual funds? Yes, the RDA platform does offer in overseas investors, overseas Pakistanis to come into through the RDA system, invest in AMCs. That option is available, has always been available, and it's a great option if you want to invest in the Pakistani market. It's a much easier platform for overseas Pakistanis to come through. Last question. We would go for again on equity. So why doesn't Alfla launch a KC index tracker or an ETF that tracks the KC 100? Very simple. In Pakistan, I think over the last 5, 6 years, the market has been very volatile. Some sectors perform, some sectors don't perform. So I would say that fund managers, portfolio managers, the investment committees that run these mutual funds have usually outperformed the KC 100 over the long term. So you have to choose your fund manager, choose the right fund, and you can perform better than the KC 100 as well. So I think, ETF is an option for a passive investor who can just wants to track the KC 100. But our target as fund managers, as the investment committee, is always to give a little more alpha than what the KC 100 gives. And that's our target, is that we want to generate a lot more wealth while managing our risks. Um, so that's the end of our seminar today. Again, thank you very much for all of you who have been listening in. And inshallah, we'll be doing some more of these seminars. And if you have any questions, any feedback, please send them in to our um, via our website or through our app. We'll be glad, looking forward to looking to